Let's get things started. Welcome, everybody. Welcome to Safe Option Strategies presentation of You Never Have to Lose Money Again. How great would that be? Hi, everybody. My name is Jeffrey Dunyan. I am the owner and founder of Safe Option Strategies. I'm going to be the one sharing this presentation with you for the next 45 minutes to an hour. Just by way of a little bit of background, I've been running Safe Option Strategies now for, I believe we are in our 14th year. I've been teaching people how to trade stocks and options for closer to 17 years now. We go back to 2002 when I started to teach people. We're going to talk about how to trade with little to zero risk, protecting your principal and your profits. Now, I cannot think of a time when it has been more critical to learn how to protect your money. The worst thing you can do when the markets are like they are right now, and they are crazy volatile. I mean, these are some of the most volatile market conditions I have ever seen. But if you sit on the sidelines, if you take, you can't make money when your money is sitting on the sidelines. You don't lose anything, and that's a good thing. But I'm going to show you how to not lose anything. And that's critical. That's the most important thing. I'm going to show you how to not lose anything and profit when the markets are crazy volatile like this, when they look really, really ugly like they've looked over these last few months. I mean, I know people are scared right now. The reason the markets are doing what they're doing is because people are so scared. They are so nervous. When's that next massive drop going to be? What am I going to be exposed to? If I go bearish on my positions, if I position things so that I can make money in a downward trend, when am I going to have another 1,000-point update? During that week between Christmas and New Year, we had the single largest dollar gain, not percentage, but the single largest dollar gain the markets have ever experienced in one day. That happened just like a week ago. And if you position bearish because everything has been selling off lately, what do you do when it's all of a sudden moving bullish? This is absolute craziness that's going on in these markets. But you know you can't make money sitting on the sideline. This is going to focus largely on the core strategy that we teach at Safe Option Strategies, what has made us successful, what has made our students successful over the years. This is going to focus on spread trading strategies that involve options only, but how to be more successful and more profitable with option only trades. And the reason I point that out is because this is right 100% of the time. That's not an exaggeration. This is right 100% of the time. When you're not trading like this, you got to be able to get it right 75% of the time with this. And most importantly, you've got to know what to do in the 25% of the time you're still going to be wrong. This is last year in the market. We had this amazing January, amazing. And then look where we finished the year, down 6% on the Dow. What did we finish? 4.5% down on the NASDAQ. And I want to say 6.4, 6.5 down on the S&P. And with a lot of chop in between. Remember February and how ugly that was? But by the end of the month, we'd got a lot of that back. March stunk, and then we made a climb to all-time highs, but not without a lot of chop and a lot of volatility. And then look what happened this last quarter. I mean, this was just ugly. 6% down on the year in the Dow, but in that last quarter from the highest point to the lowest point, almost bear market territory. Not quite. Some people would tell you that we did hit bear market territory. Technically, by definition, bear market territory is 20% down. We came close, but not quite. I have a feeling that sometime in this early first quarter of 2019, if we look at that most recent high as the first part of October, this is going to go well over 20%. I could be wrong. I kind of hope I am, but that's what we're headed. Some of the best performing stocks have taken the biggest hits. Apple, high of 232.66, low of 146.72, all in that last quarter, down 37% from that high spot to that low spot in the fourth quarter. And for those of you that are with me live right now today, what's happening to Apple today? They've been down almost 10% during the day today. They have gone lower than this lowest point because they just revised their guidance and they revised it way down. Amazon, down 36% from their high back in September. Facebook has had the troubles that the overall market has had, plus they've had those issues with privacy laws, and they've been called, Mark Zuckerberg has been called to Congress a couple of times. I mean, they've got issues there. Down 44% from their high back in the end of July. And Micron, holy smokes, if you were invested in Micron, since they hit a high back in late June, that has been a train wreck. They have given up half of the value of that company. Now, those were some of the best performers from the previous 2 or 3 years. Unbelievable the way this market has turned on us. How do you fix it? How do you take? That's really what you're here for, right? You don't need a history lesson on what happened last quarter or last year or the last 10 years. What you want to know, I hope, is how do I fix this? Number one is you fix it through learning how to place low to zero risk trades. If I could show you one simple thing that would guarantee you better results in your trading, would you do it? Our reflex answer is yes, of course I would. And then here's what I say. I'm going to teach you how to do a collar trade, a dynamic collar trade, not the definition collar trade that you look up online, a much more dynamic version of the collar trade. And the collar trade involves owning some stock and using options along with that stock. And do you know that over all the years that I've done this, of the nearly 100% of the people who say, yes, I would do something different. If you'll show me how to do it, I'll do it to get better results. I mention stock ownership and the majority of them say, I don't want to own stock. Now I'm not going to beat up on anyone. I'm not going to pick on anyone. But do you know how ludicrous that sounds? I mean, put yourself in the shoes of the person asking the question. If I could show you one simple thing to do that would guarantee you better results, but that simple thing is going to involve some stock ownership. And then you say, hey, I want the better results, but I don't want to own stock. Let me show you how we do a dynamic collar trade and set up low to zero risk trades. And then I'm going to show you how we can make fantastic profits on them. Number one, you set up a collar trade like this. You buy stock. Now, I purposely chose a fairly inexpensive stock. This works with any stock that has options. Okay, in 44 days, and I think I took this screenshot yesterday, so 43 days now. In 43 days, our February monthly options will expire, but in only 13 days from now, Bank of America is going to give us an earnings report. They're going to tell us how they did last quarter. If we buy the stock, we take a chance on them making their earnings or missing their earnings, and good or bad, that could really affect what we do. We could make a lot of money, we could make a little bit of money, we could lose money. So what we're going to do is buy an insurance policy. We're going to go out and get the 25 strike price long put option. In every way you can think of, and occasionally I have an insurance agent that emails me and say, no, this is different. Okay, for us lay people that aren't in insurance as a living, in almost every way, this 25 strike price long put works like an insurance policy. What we're going to do, this is going to be our home. This is going to be our homeowner's policy. This is the premium of the homeowner's policy, and this is when we have to renew the policy. In almost every way, this works like a homeowner's policy. This works like an auto policy. We pay a premium. We insure our asset for a certain price. We have a certain time period that we're insuring it for. That's how a long put works when you use it with stock. So we buy our stock. We buy our long puts. Now, we're going to go back to high school. We're going to go back to the first car we owned, and we're going to get help from mom and dad paying for our insurance. We're going to go out and sell a call, covered call. That's all this is. Those of you that trade options, you know what a covered call is. And if you've never traded options before, because I know there's a few people that watch this presentation and everything I'm showing them is brand new to them. This is what I do for a living. I teach people how to do this. So from the very beginning understanding of what options are and how they work to the most complex option strategies you can think of, we teach you all of this. So don't worry if you stay with us in concept, even if you don't know the details. Don't worry about learning the details if what I'm showing you gets your attention. Okay, we get our insurance policy. Now we write a covered call. We get mom and dad to pay for our insurance. Our net out of pocket when we spend this, and we have this paid to us is $25.04. How much is that if you're doing 100 shares? Because this one option contract covers 100 shares. We can't write a short call for one contract unless we own 100 shares of stock. So this does have to be done in increments of 100. 100 shares means removing that decimal a couple places. That's how much it's going to cost us to do 100 shares of this trade. Here's why I'm pointing this out. I just spent all that time saying most people don't want to hear about trading stocks. They're option traders. And the number one reason they don't want to trade stocks, even though I can show them a way to make a lot of money and be way safer in doing it, for most people, the reason they don't want to do that is they say the stocks are too expensive. I've only got $5,000 in my account and I can't trade stocks because I can't own stocks. Yeah, you can. Yes, you can. And you can be very profitable doing so. I'm showing you how to do it even with a smaller portfolio. Okay, $2,500, $4 is our investment. Now, here's the beauty. Between now and the expiration of our long puts, during the time of our insurance policy, that's the maximum amount of money that we can lose. Right there, 4 cents. How do you like to have $2,500 of your money invested and the maximum you could lose is $4? And we're setting this up specifically for the earnings report. So once that earnings report comes, and I think it's scheduled for the 13th of January. I could be wrong on that date. Don't hold me to that if I'm off a little bit. I think they're scheduled to report on the 13th. So guess what happens? After the 13th, we're going to make money. We're going to make money if the stock goes up. We're not going to lose anything but $4 if it goes down. And I'll show you in a minute how to profit if it goes down. Let me show you another example. Southwest Airlines. We could buy the shares at 40, as of yesterday, buy the shares at 47.02. There's our insurance policy. We now have the right to sell this stock at 47.50. We're going to get someone else to pay for our insurance. And for the next 43 days, and guess what? They report, I think, on the 26th or the 27th of this month is when they report. I have zero risk between now and then. And if the stock takes off to the upside and I have to sell it at $50 a share, I can still make money. I can still make a profit. Some of you that know how covered calls work, I see people typing in comments to me, what about the covered call? You have to sell the stock. Okay, yeah, I get it. And if you have to sell the stock at $50 a share and it's trading at 70, that's okay. You still made profit. Isn't this better than what happened last year? What happened to us last year? The Dow lost 6%. The S&P lost 6.5%. Isn't this better than this? Should be a negative right there. This is how you trade with zero risk. I'm going way back now. See that this says November of and that's November 16th of 2018. This goes way back. This is a trade we did. Here's one that we did not too terribly long ago. I set this trade up about 3 months ago at the very first part of October. I think this trade was set up on whatever the first trading day was on October. Advanced Micro Devices, AMD. At the time, they were trading for $27.59. Anybody know where AMD is right now today? $17.31. You know what kind of a loss that is? Now, $27.59 minus $17.31. They're down $10.28, and they're down 37% right now today from where they were at the first trading day of October. I set up this trade the first trading day of October. Got my long puts. There was my insurance policy. Got someone else to pay for my insurance policy. It cost me $2,774 for every 100 shares. I did this trade with a lot more than 100 shares, but for every 100 shares, this is what it cost me to be in the trade. And for those 44 days, I had zero risk, because if I have the right to sell at $27.74, or excuse me, if my position cost me $27.74 and I have the right to sell at $28, I've got zero risk. And here's what happened. This is what my max profit would have been if I had been called out. But here's what happened. Now this says AMD open trading today at 1772. Today was October 25th, I believe. You can go back and double check me. I was in this trade for about a month, a little less than a month. They reported their earnings. They missed. They had a huge sell-off. They opened at 1772, down $9.87, almost, I think, a little over 35%. This is how much my long puts had gone up in value that day. See how much more that is than the stock lost? My short calls had gone way down in value. So they were worth a lot more. The combined profit here and here versus the loss on the stock. Now, this doesn't look like a lot, does it? 63 cents per share when the stock was down 36 cents, or 36%, sorry. Anybody know off the top of their head what 63 cents per share profit is on a 27.74 investment? I was up 2.3% on a 1-month trade that had zero risk, could have made me 8% if it had gone the way I was hopeful. I was hopeful this would go bullish. When they got to their earnings report at the end of October, my hope was that Advanced Micro Devices was going to go bullish. They went way bearish on me. I got out of this trade in a month with 2.3% profit, 1 month. Now, that doesn't sound like a lot. What is that if you did that every month of the year? 2.3% times 12 is 27.6%. How much better is that than what the markets averaged last year, the Dow Jones or the S&P? Which of these would you rather have? Who thinks they can't afford to trade stocks? Folks, this is what we teach people how to do at Safe Option Strategies. This is what we teach them how to do. Here's how the trade worked. Here's how it broke down. There's the day we got into the trade, October 4th. I was off a little bit. I'm sorry. I thought we got in back here. We got in on October 4th. I knew it was in the very early part of October. We set up the trade with those 28 long puts. We did those short calls that were farther out in time, out of the money. Stock dropped significantly. Long puts went way up in value. Short calls increased in value. The combination of both of them offset the loss in the stock. We made profit. Okay, that's simple. Longer term, you can really go crazy with this. Let me show you something really quick. And this is a large part of what we teach at Safe Option Strategies. Anyone heard of cost averaging? Everyone here knows what cost averaging is, right? You people that are on live. Okay, question came in. Let me answer this question really quick. I'm sorry, I'm going to back up a little bit. I told you I'd answer questions as we went along. Let me go back a couple of screens and answer this question. I'm going to clear all of this off right here. Very astute. I appreciate that you picked up on this. We've got protection for 44 days in this trade, but we've got short calls that don't expire for 170 days. What do we do if we get close to the 16th of November and the stock is still trading close to here and these are expiring, but we've still got these short calls? And if these expire, now we've got a lot of risk. What's 107 days minus 44 days? Now we've got 63 days that we're not protected. Okay, that's I'm summarizing. That's the gist of the question that Adam just typed in. What do you do in those 63 days that you no longer have protection? Okay, one of the reasons I called our way of collar trading a very dynamic way of collar trading is because one of the things we teach you in the education is how to profit if the stock goes up, how to profit if the stock goes down, and how to adjust it if it stays flat. Or maybe it goes a little bit up, but it's not enough to get real profitable. Maybe it goes a little bit down, but it's not enough to actually get profitable. What do you do in this no man's land right here of stagnant, and this could be a very volatile stagnant. It could be stagnant over a period of time, but with some swings up and down. What do you do during this time period and this 63 days that you don't have protection? We teach you when and where to roll your long puts to, when and where to roll your short calls to, and you just extend your coverage like you do with any other insurance policy. When you have when you have an insurance policy on your home, it expires each year and you have to pay it again. And it's okay if your home is going up in value, and hopefully the premium comes down if your home is going down in value. And if you get someone else to help you continually offset the price of that insurance, then it doesn't matter. But it's a great question. And this is not where I teach every secret that we have at Safe Option Strategies. But that is one of the core things that we teach. That is one of the core things that we teach. And I'll give you an example of that. Now, let me hurry back to this screen. Dollar cost averaging. You buy some stock at $100 a share. The stock is dropping. Okay, this is what we've seen happening the last quarter, right? The stock is dropping, and you add some more shares here, and you add some more shares here, and you add some more shares here, and you have 100 shares at $100 a share. Is that $10,000? Okay, there's $10,000. I don't want to tell you, I get my decimals in the wrong place once in a while. There's $10,000, and we buy another 100 shares here, and there's $8,000. And we buy another 100 shares here, $6,000. And we buy another 100 shares here, there's $5,000. And why do people do this? Why do people cost average? Well, what happens is you now have 400 shares. Okay, you now have 400 shares. You have $10,000 plus $8,000 plus $6,000 plus $5,000. You with me here? You've got $29,000. And if you divide that by 400 shares, your average price per share ends up right here. Your average price per share is now $72.50. So when that stock gets its bounce and starts to come back up, it doesn't have to get back to 100 for even this investment to be back in the profit, because this one is now profitable. This one is now profitable. This one has only lost a little bit. And once you're back above $72.50 a share, you could get rid of all the shares and break even or be a little bit. This is why people do cost averaging. Here's the problem with cost averaging. The problem with cost averaging is to make this work, in addition to your original $10,000 investment, somehow, some way, somewhere, you got to come up with another $8,000. And then you've got to come up with another $6,000. And your investment that started out at $10,000 triples to $29,000 for you to get that average price down to $72.50. And what if the stock never makes it back up to $72.50? You've tripled your investment and you might still be losing money. That's the problem with dollar cost averaging. Using the collar trade, okay, that dynamic collar trade that I just set up for you, using that, here's what we do that is so incredibly different. We buy the stock. We also buy the long put, and we get someone else to pay for the long put. When the stock drops, the difference for us is that we have the profit from these long puts. As the stock price is going down, this value is going up. Okay, let me really quickly go back to the screen that I was on a minute ago. When the stock is going down in value, the long put and the short call are increasing in their profitability. It doesn't have to always be like this. Sometimes it's going to be about equal. Sometimes this is not going to go up quite as much as this goes down. That's okay, because what we're going to do is we're going to sell those long puts, and we're going to use that money to buy our other shares. Our investment that was originally $10,000, we don't have to increase that investment to $29,000 when we get here. We're just going to take these profits and we're going to add them into stock ownership. And what happens is we double our number of shares, but we use the profit from the long puts, and our average cost per share is right down there where the stock is trading. It doesn't, if it gets back up to 72, we're somewhere in the neighborhood of 48, 49% profitable. If it ever gets back to 100, we're 100% profitable. We have protected ourselves all the way down in this drop. We've protected ourselves, and now we've given ourselves the ability to leverage into a whole bunch more shares without any more money. Our investment stays the same. Our number of shares dramatically increases, and any little movement up gives us profit, and movement back to where we were at one point in time gives us massive profit. This is how it worked with advanced micro devices. This is how it works. Right here, we add more shares. Let's say hypothetically, let's say we did this trade with 200 shares. That's the original investment right there. Oh, I said 2,000. See, I can't keep track of zeros. That's why you hear me asking. If we had done this with 200 shares, that second set of shares we have is zero relative to our investment, because we took money in of $2,100 from this, and money out was $1,700 to get these next 100 shares when they were trading down here. So now we have 300 shares and we still have this same original investment, and our average price per share is $18.49. If the stock gets back up to here, we're profitable. And there was money left over. There's money left over from that 2100 and that 1772. So this is how we make great money. And this is, I'm going to go through this really, really fast. I told you at the beginning of the presentation, it's always my goal to stay within an hour. I'm going to rip through this really fast. So if you're watching a recording, because I know for every person that watches this when I do it live, 20 or 30 others watch a recording. So you may be watching a recording of this right now. I had a student just using what I showed you. And this student of mine, in August of 2013, this $4,300, that represents the majority of a $5,000 portfolio that he had. That's why I chose this example. I've got example after example after example of students who have done similar things to what I'm going to show you. I chose to share, and I got his permission. I chose to share this one with you because he only had $5,000 to start with. And just doing what I showed you now, protecting the stock in downtrends or going into earnings reports. When the time comes that long puts are sufficient to add shares, we add shares. We wash, we rinse, we repeat. Have you ever seen that on the back of a shampoo bottle and heard comedians make jokes about it all the time? Wash, rinse, repeat. Wash, rinse, repeat. We just do the process over and over again. 18 months after buying, and look, anybody follow JCPenney? When this student reached out to me and shared this trade with me, the first thing that went through my mind is, why in the world did you buy JCPenney? I would not have chosen that stock. You know why he bought JCPenney? Because at the time, that's what he could afford. Do you know what he did for a living? He drove truck for a living. And you know what he delivered products to a lot? JCPenney. He didn't work for them, but he kind of knew a little bit about the company. It was a company he was familiar with, and it's what he could afford. And 18 months into this trade, he was up 182%. Just every time he had an opportunity to leverage into more shares, he did so. He stayed in this same trade for 3 years and 4 months. And folks, if nothing I show you is going to grab your attention, you tell me right now that you're not interested in turning this kind of money into this kind of money over the next 3 years. I can't promise you that you'll do that. I'm telling you it can be done because I've helped people do it repeatedly. Here's a trade that we put on with our students. And then I'll explain to you what I mean in a minute when I say we put it on with our students. We got into an Under Armour trade way back in June of 2015 when the stock was still trading up in the $40 to $50 range. Just doing what I showed you. We leveraged into more shares. We were only up about 56% in the first year, and the stock was up a little bit during that time, but then they went into their fantastic sell-off. When the stock was down 50%, we were up 100%. When the stock was still down over 50%, we were up almost 200%. And if you follow Under Armour at all, you know that they've been up here a couple of times in the last few months. And they've also been down here a couple of times in the last few months, and we've leveraged into even more shares and grown the position even bigger since the time I put all this information together. Here's another trade we did just recently with Under Armour. This is one we did just around that same time last year when the market started getting real crazy volatile. $1.50 per share on an original $19.42 investment. Okay, $1.50 divided by $19.42. We were up almost 8% in this trade when the stock was down 8% from where we got in. Folks, this is a fantastic way to trade. Now, I can teach you how to do all of that. Some of you are still going to be interested in option-only trades. I'm going to fly through this next part, in part because I'll show you where you can go to my website and see a separate, if you want to, I'll show you where you can see a separate presentation that deals a little bit more with the option only trading. If you want to, in spite of what I've just shown you, if you still want to trade options only, two things you've got to do. Number one, you've got to learn to get it right 75% of the time, even in volatile markets. And here's how you're going to do this. A few months back, when I was setting up one of these presentations, I was setting up my stock charts to put in some screenshots and make this presentation for everybody. And I had this great reminder of all these different technical indicators. Ikimoku clouds, Keltner channels, chandelier exits, pivot points, Bollinger Bands, commodity channels, correlations, Chaikin oscillator, Chaikin money flow, Kopach curve, ease of movement, force index, Arun oscillator, accumulation distribution lines. I could find, for every one of these different technical indicators that you can set up on a stock chart to look at, I can find you a couple of individuals who swear by that being that's the magic formula. That's the magic beans. I know people who think this is the magic beans that's going to grow the beanstalk. I know people that think this is the only magic bean. I know people that say, if you look at these and you look at this, that's the magic beans that's going to grow the beanstalk and you're going to get the treasure. It's all white noise. It's all background noise. It's all muddying the waters. People all the time get bogged down. You've heard the term paralysis by analysis. This is it. This is paralysis by analysis. This bogs people down. I'm going to simplify it for you and give you a 75% formula. Look at the RSI, the 5 and 20-day moving average, and the MACD, because historically, 75% of the time, when those three things cross over, bullish or bearish, at the same time, you get a continued trend. A trend is more than 2% movement in the direction that it just crossed over, or more than 2 weeks. That is a trend. This is not a trend when the stock pulls back a little bit and then starts going this way. This is not a trend when it dips a little bit and goes back up. It wasn't more than 2%. It wasn't more than 2 weeks. When the technical crossovers came at the same time, we got more than 2 weeks. We got more than 2%. In today's markets, more than ever before at any point in the history of the stock market, you have got to get those trends right more often than not. And more important than any of that, you have got to know what to do with this 25% of the time that you don't get it right. And when we get real crazy, squirrely volatile like we've been the last few weeks, the last few months, it might go to 60-40 for a short period of time. Historically, it's still going to be 75% of the time that these indicators are accurate. But you got to get, you got to know how to plan your trade. You got to know how to plan your exit. And this is the key to everything right here. This is what to do this is the 25% that we're wrong. What do I do in this 25% that I'm wrong? What you're going to do is learn through a very detailed process how to adjust spread trades, how to adjust option only trades. All right. I'm not going to take a lot of time to demonstrate or show that. You can go to my website and I'll show you where. You can go to my website and you can look at a class that goes into a little more detail on adjusting option only trades. If you're option only trading and you're managing your percentage return and you're in short-term 1 to 2 to 3 week trades, this is typical of what people do. They take that profit, they reinvest it so that their next trade is that much more. They take the profit, they reinvest it. They take the profit, they reinvest it. And this is what most people do when they don't know anything about trade adjusting. 3 out of 4 trades go exactly the way they want and they get the return they're looking for and they're growing their portfolio at a very nice pace. And then one trade moves against them. And everything they gained and then some is lost. And even though 3 out of 4 trades went their way, they're looking at a 35% loss to their portfolio. Through learning these adjustment strategies, what to do when it goes the way you don't want it to go. This is what we teach. This is a large portion of what we teach at Safe Option Strategies. And if you learn this, this is what the difference is. You're getting similar returns on similar time trades with the big, huge difference that because you set it up correctly and know how to adjust it, You can get a fractional loss, a zero loss, or maybe a small profit. And look at the difference on the same 4 trades. Same 3 out of 4 went the way we wanted. Same 1 out of 4 went against us. But because we knew how to adjust it, look how much different we're at. Look at the difference. Okay, I got to breeze past this part so I can stay within an hour. Anybody heard this saying before? Oh, sorry. Go to safeoptionstrategies.com. There is a link there that says learn the right way to trade. Okay. On that link is going to be a copy of this exact class that you're listening to right now. And down below that is going to be a second intro class that focuses more on the option only trading. Okay, you can watch a repeat of this one, or you can scroll down the page a little bit and watch the one that's on option only trading. It's just take the spaces out of here, Safe Option Strategies, all is one word.com. All right, now everybody's heard this, right? Feed a man a fish and you feed him for a day, teach a man to fish and you feed him for life. I've heard that growing up. I've heard that my whole adult life. I've heard that apply to many different settings. And I always felt like there was one very important part of this missing. And that is, what happens if the man or woman starves while they're learning how to fish? Okay, I've got a really good friend of mine and a brother-in-law who I consider a very good friend. These are the 2 best fishermen I know in my life, and they are good fishermen. They don't fish anywhere and without catching stuff. And I'm telling you right now, if they tried to teach, and they have tried in the past, and I'm not a good fisherman, if they tried to teach me how to fish and I had to rely on what I caught to stay alive, we would go out in the wilderness and I would survive. Or excuse me, we would go out in the wilderness and they would survive and I would starve to death. I got to say it the right way or it doesn't make any sense. They can teach me how to fish, but it's going to take them some time. Little things. This is one little thing that they've told me and I still haven't quite got it. I'll cast to the same spot they're casting to. I'll put the same kind of bait on my hook. I'll have the bob set up the same way, and I'm doing everything the same as they're doing, and they're bringing in fish and I'm not. And they tell me, you've got to get a feel for when that fish is nibbling versus when it's time to set the hook. See, I want to set the hook too quickly or I wait too long. If I try and set the hook too quickly, I pull it out of the fish's mouth and I don't hook the fish. If I wait too long, the fish nibbles all the food off of the hook, and most of the time they're able to spit the hook out without it hooking them. These guys know just that right amount of tension, that right amount of tension on the line that means the hook is far enough in the fish's mouth that they can set the hook and they can pull it in. Now, over time, they can teach me how to do that, but I would starve to death if I had to rely on what I pulled out of the water. If we were out camping for a couple of weeks or a month, what we do at Safe Option Strategies is we teach you how to fish and we feed you at the same time so that you don't starve while you're learning how to fish. Okay, there are dozens of companies out there and dozens of individuals that offer advisory services. And I hear over and over and over again from my students that they don't work. I did so-and-so's advisory service and I paid $5,000 for the year for it and I barely broke even or I lost money. Or I did so-and-so's advisory service and I lost money in the first 3 trades that I made. Or I'm following so-and-so's advisory service and it doesn't sound like he knows what he's doing. A lot of advisory services are just people show you a trade and then you're on your own. And you got, or what my favorite, this is my favorite. And I'm being very sarcastic when I say this. I'm not going to name the person by name. There's one particular advisory service where the guy does really good risk to reward ratio trades, meaning he's got very low risk and very high reward on this trade. So you're only going to put $1 per share at risk for a possibility of making $4. This is just a hypothetical example. Very low risk, very high reward. And people look at this and they say, wow, if I could just, if the worst that had happened is I lose $1, but the best is that I make $4, God, if I got 3 out of every 4 trades right, I made $4, I made $4, I made $4, and then I only lost $1, and that's great. That's fantastic. What people don't look at or don't know, or what's left out of it in a large way, is that these trades are incredibly low probability. In other words, the chances that that trade will make $4 versus losing $1 are about 10 to 1 against it. And some of you know who I'm talking about. I'm not going to mention him by name, but some of you know who I'm talking about. If you're going to do an advisory, you've got to make it very easy to understand, simple analysis and explanation. You've got to make it very easy to follow the instructions, easy to set up step by step. Everything's got to be there. And this is what's missing in most of them. Every single week, we send our students new trades. We follow collar trades from, for long periods of time, and students can jump into these collar trades when they want, and they can follow. So as they're learning how to do this, we will keep them fed. I've got students who have signed up with our program, and the day after they sign up, they've got money working for them in the same trades that we're doing, and we tell you every step of the way what we're doing so that you can do the same thing if you want to. And look at what we have done over the years that we've been. This is when we started doing the advisory. For a long time, I was an education-only company, and then about 6 years ago, we actually did an advisory in 2010 and 2011, and then we skipped 2012 because we wanted to make sure we were in perfect 100% compliance with the SEC in the way we were doing it, how we were wording things, making sure we weren't violating any of their rules. So these 2 years were similar results to these. Worst year we've had since our advisory, and look at how we beat the market averages. This is the worst year we've had, and we crushed what the markets did. This is, look, I told you I wouldn't make this a big giant sales pitch. Folks, I'm telling you, we've got a program. If nothing I have shown you is of interest, then I wish you the best of luck. I hope you find what will work for you. I hope you're successful. But I'm telling you, whether you want to focus just on collar trading, if you're one of those people that absolutely you do not want to own stock, you can do the spread trade program only. And by the way, this is our spread trade results. That's what I'm showing you right here is our spread trade results. Our collar trade results blow these out of the water, but the advisory works very different with the collar trade. And a lot of the profit depends on when you entered. In other words, someone that entered a trade 3 years ago might be averaging 100% per year, but someone who entered the same trade partway through this last year, they may only be up 6 or 7% right now, or be flat, but they've added a whole bunch of shares. If you're convinced you don't want to do stock, you do the spread trade only program. You combine the two courses, and we make this an incredibly good value for you, an incredibly good deal. And folks, I am absolutely convinced that if you decide to join Safe Option Strategies, it's the last purchase you're ever going to make. I know for a fact that a lot of you have spent money previously on other education companies. If you've done it real recently and you're within their grace period to get your money back, take a close look at what we're doing and see if you can do that. If you do our program, any one of those levels, I am convinced this is the last time you'll ever need to spend money on investment education. I'm so convinced that this will make a positive difference in the way you trade that I back it up with an unconditional money back guarantee. And the only thing I've ever looked at to measure the success of Safe Option Strategies is the success of each individual student. You know that you're online with a group of people right now, or you're listening to a recording at home, and you and I don't know each other personally, but I'm talking to you personally right now. If I cannot help you become a more successful trader, then I'm not succeeding as a businessman. And that is the pledge that I make to you. If you want to get more information about what we're doing, if you have questions, unfortunately, you can't click on this link. You have to actually type that in, info@safeoptionstrategies.com. You can call. A lot of time, we're not a huge company. I've got 4 full-time employees, and I work with a very select small group of people. I'm not trying to be the biggest investment education company out there. I'm not trying to grow faster than other investment education companies. I want to work with people that are very serious about what they're doing and who are willing to make a commitment. Now, I'm going to tell you right now, compared to almost everything else you look at out there, We have better prices than almost everything else out there. I know that because I look at it. I have some employees of mine that look at it on a regular basis. We know that we're priced better than most education companies, and we provide a lot more content. But I know it's not always easy to pull the trigger on an investment in something like this. It's not always easy to make that commitment. Here's what I'm going to do. If you will email or call within the next 2 hours. Now, when you look at this as a recording, you that are watching this as a recording, and maybe you're watching it a week later, 2 weeks later, I do a new class like this approximately every 2 weeks. So you may be listening to this right now, and we're 2 full weeks into the month of January. Okay, for those of you that are on live with me right now, you know what today's date is. But I make people register to show that they viewed the class because it's easier to communicate with them if something went wrong with the class, if they have questions and so forth. And I know when you viewed the presentation. If within the next couple of hours, and I'm a little bit flexible in that, if you will email or call, leave a message if you have to. And if all you'll do is say, tell me about the special pricing that you've got going right now. Okay, our prices just went up a little bit for 2019. It wasn't a huge price increase, but every single one of our vendors, the GoToWebinar people, the Critical Impact people, the stock charts, everybody that we deal with to run our company, our web hosting company, everyone has increased their prices a little bit. We've increased our prices a little bit. If you will call or email within the next couple of hours and ask about discounted pricing, for the duration of this presentation, I will continue to offer the 2018 pricing and the discount program that we were offering between Thanksgiving and Christmas. And it's a pretty deep discount. It's a pretty incredible discount. I'm convinced that with the discount, you're not going to find anything. I'm not going to pretend that what we're doing is cheap. Folks, if it's cheap, I end up working with a lot of people that are not real serious about what they're doing. With that said, I don't want to make it expensive. I want it to be affordable. I'm convinced this is going to be one of the most affordable educations you'll ever look at. And if you will email or call us and request pricing information, I think I'll shock you with the discount that we're offering right now for a very limited period of time. I'm going to end right there. For those of you that are on live, for those of you that are with me live, I'm going to stay online and answer some of your questions. For those of you that are listening to a recording, thank you for joining us. This is the end of the recording. I sincerely hope to hear from you. There's no obligation to buy anything, but make a call or send an email and ask about the pricing. I'm not calling anyone or emailing anyone unless they reach out to me first. We do not bug people for their business. We do not chase you for your business. But if you want to know the kind of pricing deal you can get right now, call or email. We'll send you details on the pricing, and we'll let you decide if this is a good fit for you or not. Thank you for joining us. Have a great day.